Good afternoon. Welcome to the GTR West Africa Structured LC panel discussion, where we're hoping to shine a light on the maybe arcane, maybe controversial, but crucially important topic of structured LCs in emerging markets, particularly for developmental trade finance. So I'm joined this afternoon by some industry practitioner experts and ITFA ARC members in the form of Albert Mamu, I hope I've pronounced that right, Albert, senior underwriter at ATI, Shalina Govind, transactor and debt and trade solutions in Financial Institutions Group at RMB, and Simon Cook, partner at Sullivan and Worcester. We're hoping to start with a couple of poll questions to set the context for the discussion. I'm hoping we can go to the first poll question now, please, Dan. Have we got a poll question up? There we go. So the first question is, have you, as a member of the audience, been involved in structured LC transactions previously? Okay, so you just leave it a little bit more time to settle, but it looks like a sort of 60-40 split at the moment. So 60% yes or 64% yes. So that's a good indication the audience is involved in the product. And then if we could just move to the second question, please, Dan. And the second question is, are structured LCs actually trade finance? And there are three options here. Yes, they are used in trade finance in emerging market countries and enjoy trade regulation and UCP support. The second is no, they are over-engineered general financing products. And the third is, you're not sure, you don't know, you're not entirely sure what they are. We'll just give that a little bit more time to settle. Okay, so I think we're more or less there. I'm seeing that as 57% yes, 28% no. That might be my eyes. And 14% not sure. Okay, that's very helpful. Thank you. That's very helpful in terms of setting the context for the discussion. There has been a white paper drafted by ITFA on what is quite a recondite topic and product. That paper is due to be published very shortly, and I think it's right to say is the only actual industry paper on the topic, definitive industry paper on the topic. We also drafted an ITFA January 2021 newsletter article on exactly this topic and as it pertains to Africa and how important it is for African trade finance in terms of closing the trade gap, as well as supporting SME trade in Africa and liquidity and FX constraints in Africa, both prior to COVID and, more importantly, post-COVID. And those are some of the topics that we're looking to dive into later in the discussion. Just before we get there, I'm conscious that some of the audience are not necessarily apprised of what structured LCs are. So we thought we'd just set a little bit more context and give a brief description of what structured or synthetic LCs actually are and how they work. And for this, we've got a diagram that comes out of the ITFA white paper. Dan, I hope you can just show that on the screen. So very briefly, without going into too much technical detail, the way that we'd like to approach this from a description perspective is we hope that the audience is largely aware of LCs, letters of credit, standard, normal, vanilla letters of credit, and we look to differentiate between what are sometimes called prepaid LCs, sometimes called synthetic LCs, or structured LCs, and your normal common or garden variety LCs, by differentiating the important distinction, and that is where largely the applicant and beneficiary may be related parties, and the LC runs its normal course, with being issued by in the case of structured LCs, usually an emerging market issuing bank that is issued to a confirming bank, usually an international bank or regional bank, who confirms and discounts that LC to the beneficiary. The beneficiary then, and this is where things start to move slightly differently, the beneficiary then pays the discounting proceeds across to the applicant in one form or another, and then the applicant then deposits those proceeds with the issuing bank, and the issuing bank is then able to enjoy those proceeds for the tenor of the LC as a very well priced deposit. It is a kind of form of banking product for emerging market banks to improve their dollar liquidity in the short trade tenor space. So with that as the background, I'm going to ask Shalina, as a leading African bank participant in the African structured LC market, what are the key points that you'd like to highlight across the product?
Okay, thanks, George, and good morning all. I think maybe to start off, being a very trade-focused and one of the leading regional banks supporting trade finance on the continent, our journey with structured LCs started off in very much the same way, I think, as most others, from a very dark place and obviously with some skepticism. So we conducted our own extensive research to gain a deep understanding of the evolution of the product, the role of the product, its associated risks, and that was through various engagements with the parties that are involved in a structured LC, be it your confirming bank, your issuing bank, and your corporate clients. So that then helped us to devise a framework or risk parameters in terms of how we execute or transact the product. In terms of our view, we regard structured LCs as a financial or a funding product, in addition to your trade loans and your LC refinances, which are used by your banks to obtain USD liquidity, which liquidity is then used to facilitate and finance trade finance within their home markets. I think, in terms of the evolution of the product initially started as an overlay to bank funding. But over the years, it has grown in importance in terms of being a key source of consistent and cost-effective source of funding to address the trade finance gap, alongside your commercial banks and your DFIs. I say consistent due to the fact that it is relatively easy to execute, underpinned by an LC issuance. And in terms of cost effective, there are obviously some pricing benefits attached to the Basel treatment of LCs, as well as the corporate deposits which accompany the structure. I think we've all sort of heard a lot about the trade finance gap, and it's been mentioned in a few sessions thus far. But I just want to share some perspectives as it relates to structured LCs. The report that was published in September 2020 by Afrexim and the AFDB highlighted a few key points. Between 2011 and 2019, the trade finance gap was estimated at 91 billion. Over that same period, the amount or the level of bank intermediated trade finance was 417 billion, which does actually sound like a lot. However, that only represents 40% of banks that have intermediated trade finance in Africa. Whereas if you look at the stats globally, 80% of trade finance is intermediated by banks on a global level. Also, interestingly enough, the average bank participation rate was highest in North and West Africa, both markets which have used and continue to use structured LCs quite extensively. Another point that the report did highlight was that trade finance provided to SMEs has consistently decreased since 2017. And in fact, the approval rate in 2019 was 40%. We expect that with the pandemic, that has probably worsened, and maybe even more so in terms of new developments where perhaps alternative financiers that were accessible to this market before are no longer accessible. So pre-COVID, there were definitely a few trends already in circulation, that being the trade finance gap, the fact that banks have been decreasing the extension of trade finance to your SMEs, as well as correspondent banks that actually support your issuing banks in Africa was also on the decline. So that sort of created a space or a gap for structured LCs to address. And I think
sorry, can I just ask Albert if you can just pick up on that thread around particularly the SME and the trade gap support as far as DFIs are concerned that Shalene has raised?
Oh, thanks, George. That's actually a very important question. Now, I think we need to give you a bit of background for how, as an insurer and obvious DFI in Africa, we can actually come in. We do support, structured LCs, and we've been actually doing it. Recently, of course, I'm not sure whether it's because of COVID or it's just the nature of the solution. We've been seeing more of our structured LCs coming to us to the point where we feel like we can't even cope. Now, our objectives is actually can be explained in three ways. One, of course, is more to deal with the forex challenges in our member states. The second is obviously to support financial sector as much as we are supporting insurance banks who are based in Africa. And then lastly, we are supporting SMEs. And that's where now your question comes in, that most of our time, we tend to struggle to figure out, okay, how do we support SMEs? And obviously, being very passive in our involvement, we realize when we are supporting issuance banks, and in this case, and structured LCs, we are actually supporting SMEs. Now, the question is, how far can we go? I mean, we know that we have our own limitations in terms of concentration risk. We have seen more of inquiries, whatever these we are supporting them coming from West Africa. We're trying to figure out now how are we going to expand and support more of Africa, being Pan-African. The premium has never been a problem. Pricing, it's fairly okay. We've been actually, we haven't seen any complaints when it comes to pricing. I think it's fair in the fact that we are, of course, multilaterals, not very much commercial. We tend to make sure that at least we price our solutions, I mean, fairly. Now, the question is now, how do we bring on other FDIs? Because we know that, okay, we need sort of a pool. We need more of a capacity to be able to support more SMEs. And there comes now the likes of Afri-Exims. I mean, we have African Guarantee Funds. These are African DFIs who are also guarantors. They can work with us. And we're also trying to see if how on our own we can as well increase our own capacity. We have seen, okay, this is sort of a solution which people, they seem to support SMEs, and how can we actually do more to support SMEs? So we've been actually discussing internally and see how we can actually increase our own capacity to be able to support more of SMEs.
Because Shalina, some DFIs don't recognize SPLCs.
Mm-hmm. Yes, exactly. I agree with Albert in terms of the comments. However, we are aware that not all DFIs actually recognize the product as a form of trade finance or as a funding product. So you find that they are excluded from the risk sharing programs. So in that light, I just perhaps put it back to Albert in terms of, would that be seen as a limiting factor, as surely in terms of the reach and relevance with regards to escalating the recovery, surely it would be much quicker if more DFIs were on board.
Of course, FDR as confirming, I mean, the banks, if they have to act as a confirming banks, that may not necessarily be in a position to say. They may have their own, of course, reasoning in terms of cost of funds, etc. But when it comes to covering underlying risk, which is non-payment, we tend to think we can actually work together. We've been actually discussing with Afri-Exim, trying to come up with sort of a pool, a program where we can actually work together. This is more trying to tackle COVID, related transactions, but can as well now support in the likes of structured LCs. We know the likes of African Guarantee Fund can as well work with us. They've been actually working with banks. And the challenge here is which banks do we support as issuance banks? We know that most of the banks we tend to support are Tier 1 banks. Now, whether it's a knowledge gap or it's acceptance of Tier 2 banks is something which can also be discussed. I mean, we may have to increase a bit of awareness to make sure that more banks are involved and more countries are as well involved, rather than not just supporting, the likes of West Africa. Specifically in the country like Nigeria, where I think big chunk of structured LCs are actually done. And we should be able now to bring relatively smaller countries and be able now to understand. I would think it's more, not necessarily regulatory issues, it's more of a knowledge gap.
And what would you characterize the reason for some of the reluctance from DFIs, regulators, some commercial banks in actually dealing in structured LCs? Shalina, Albert? Is it this knowledge gap? Is it that they're not well understood?
From insurance perspective, this is more of knowledge gap, because I mean, we look at the transaction and we are happy with, and of course, structured LCs are the same. The structure is the same. Obviously, there are all KYCs which have to be looked at, but in terms of the structure itself, we're happy with it. We may have the situation where perhaps we don't like a trader or for whatever other reasons, but not necessarily because of the structure. Okay.
And Shalina, as far as you're concerned and what you've seen in the market, you know, what is it that makes you comfortable, and what do you think is spooking, you know, potential other partners and regulators and DFIs?
Yeah, okay. So I think I'll answer that just in terms of our framework. So we have quite an extensive list, which was devised in consultation with various teams, being your product and risk teams, in terms of how we approach the product and what gives us comfort to participate. So first and foremost is to recognize a product for what it is. What is the purpose of the product and what it sets out to achieve? And that is to inject USD liquidity, although it is done so via an LC issued in an MT700 format and governed by UCP. Secondly, in terms of having a very deep understanding of the product end to end, on both sides of the value chain, be it a issuing bank or a confirming bank. And that also allows us to then look at other aspects in terms of any legal or clawback issues with regards to insolvency of the parties that may be involved. And perhaps one point which I do want to also highlight, which we consider very important and critical, is full disclosure and transparency with regards to the corporate clients that we work with. So we work with a very selective group of clients that have a demonstrated track record of executing this product in various markets. There's demonstrated settlement, and there is also a network of large regional flows, global flows, and we are quite selective in terms of the origination and destination markets that we use to underpin these flows, always linking it back to the continents. Perhaps last point, with regards to any regulatory risks in terms of settlement and hard currency shortages, etc., we consider all of these risks, and we do monitor them continuously, as well as the credit risk profile of the issuing bank to be able to repay from their own USD balances.
So Simon, alongside the kind of knowledge gap and the lack of understanding around the product, there does seem to be these concerns around maybe regulation or risk associated with the product. Can you please touch on some of the core themes around that?
Certainly, George. Good morning, everybody. I think some of the risks involved in the structured LCs follow very closely the same sort of risks that you'd find in a typical LC structure. Certainly, if the documentation is structured properly, then really I'd probably like to start looking at the issues from the confirming bank's perspective, because in reality, they're the ones that are taking the real financial risk in the transaction. And so really fundamentally, they need to be happy with the structure of the transaction, that it looks sensible from the client's perspective, and ideally have some sort of comfort with the reputation and market expertise of those involved, because these can be quite complex to get right. We're going to look a little bit later on at the issue around regulation and what happens there, but in essence, they need to get comfortable that there are no restrictions on doing this type of business in the jurisdiction of the parties involved, particularly the issuing bank. In terms of the risks which they really need to consider, the main ones are counterparty risk.
And sorry, Simon, just on that point, as it stands today, there is no regulation anywhere globally that forbids the use of structured LCs. Is that right?
Correct, and not really, to my mind, that's surprising, given the purpose of this from the perspective of the issuing banks. They need the liquidity. This is a useful way of doing it. Why would they block it? And as I say, I think we'll probably look at that in a bit more detail later on. So in terms of the risks that the confirming bank really needs to focus on, you're looking there at the issuing bank's credit risk and the jurisdiction in which the issuing bank is located, not just from the regulatory perspective we just mentioned, but also in case there are any ancillary bits of legislation which, whilst not restricting the use of structured LCs, certainly have a potential impact on it. So, for example, if there are any restrictions on currency, FX risks, that sort of thing. And whilst that's a risk in a normal transaction, normal LC transaction, in the case of structured LCs, it can be slightly higher depending on the jurisdictions involved, because quite often the jurisdiction of the issuing bank is not the same as the jurisdiction of the applicant, which you would expect to be the case in a normal LC. So you have that potential situation where dollars are flowing somewhere without the commercial benefit of those dollars coming into the issuing bank jurisdiction, albeit that the funds are there when they are either prepaid or provided as cash collateral to assist in liquidity for the period of the transaction. So I think it's as Shalini just said, it's about doing due diligence on the issuing bank to deal with the potential solvency issues. And I think by and large, the FX issues shouldn't really be a problem unless there's some specific thing that happens during the course of a transaction which is unusual and therefore requires some sort of response from the issuing bank's jurisdiction, which would not be in the ordinary course. They've also got to focus on documentation risk, again, quite similar to what they'd have in an LC structure. But the main difference here with the structured LCs is that almost always they rely on copy documents being provided under the LC instead of originals. This has the potential impact of allowing a customer to, if you like, double fund, provide copy documents to multiple confirming banks. Now, ultimately, if it's a UCP transaction especially, this is really an issuing bank risk, because they will be obliged to pay out under the LC because the LC allowed for copy documents to be presented. But that's not going to be much help to a confirming bank if, as a result of the multiple confirming bank positions, there are solvency issues with the issuing bank. But as I say, that's a risk that due diligence and monitoring can help with. And from the issuing bank's perspective, it can easily be dealt with by just requiring under the LC just a single named confirming bank to be involved. Discrepancies also are often permitted under these types of transactions. So again, it's just a case of making sure that whilst it differs from a normal LC position, that so long as the discrepancies which are permitted in terms of reviewing a compliant presentation are consistent with the LC, then that ought not to be a particular problem. One of the main, slightly more controversial areas involved is the risk around fraud transactions or sham transactions. And I think from the confirming bank's perspective, the usual position, again, under a UCP transaction, which these pretty much always are, the fraud risk lies with the issuing bank, unless it's clear and obvious from the documents presented that there's some sort of fraud, or the confirming bank is complicit in the fraud. So that's really an issuing bank risk. There have been arguments around whether or not they would have to pay out under sham transactions. But I think we've got to be careful here, because just because a transaction is structured doesn't necessarily mean it's a sham. Certainly from the English court's perspective, what they would look at is the intention of the parties. They would look at the terms of the documents, And as long as documents were on arm's length terms and were documented in a way which would be, if you like, normal for sale and purchase transactions and has the usual things in it, then they would seek to recognize those contracts. Just because copy documents are provided, or just because the passing of title under the commercial documents does not in and of itself mean that it's a sham transaction. And so I think it's a question of documenting transactions properly to make sure we don't fall foul of any of these problems. And I think the overriding point is that as long as all of the parties to the transaction are aware of exactly what's going on, then I think it's going to be difficult for them to argue, again, from an English law, English court perspective at least, that they ought not to be liable to pay out.
Can I just ask, if any members of the panel have actually had a situation where they had issues with, aside from the case law, where they had practical issues with settling structured LCs?
Yeah, George, I think I'll come in there. So in recent years, we've not experienced any delays with settlement of structured LCs, and we tend to hear the same in the market. I do recall a particular situation some years back, but however, in a different jurisdiction, in terms of the flow of or the finality of the transaction actually being halted for a certain number of days. And that was purely due to a misunderstanding of the actual structure. And once that was cleared up and everyone was actually on the same page, the transaction was allowed to continue.
And I think one of the other points to bear in mind with this is that in terms of who's going to be most likely to challenge these sorts of transactions, it's probably most likely to be the issuing bank. And if the issuing bank is there and has been either prepaid or has been put in funds for cash collateral, then why wouldn't it? Because the effect of it trying to get out of its payment obligation really means that in the future is ever going to come to them for these sorts of transactions and they lose the benefit of the liquidity they have in the market. So there's got to be something particularly wrong and problematic with it. And you could see situations where the issuing bank, for example, might think that there's going to be an issue with its cash collateral or with any prepayment that's been made if there's an insolvency issue with the applicant and a liquidator tries to overturn. But again, so long as it's all been documented properly, and if we were acting, for example, for a confirming bank, we'd make pretty sure that what they had in place in terms of the prepayment arrangement and the cash collateral arrangement, that it did work, so that risk didn't come up. The issuing bank, therefore, would generally be unlikely not to pay out, and the confirming bank would be covered off.
And I guess one of the other pain points or issues, particularly in Africa, is potentially for transit LCs, where the applicant or the goods, the flow of the goods don't touch the applicant's country, the importer's country, or the applicant's country and the issuing bank's country. And there may be some concerns about FX. And I guess that's particularly relevant maybe in Nigeria, where you have a lot of very large banks who are regional banks, and they may want to support their business of their subsidiaries in maybe some slightly weaker countries. And there is there a sense that structured LCs may actually improve the situation from an FX perspective, rather than delving into the limited import cover of hard currencies?
I think that's the George. I mean, if I have to chip in, it's such a very important point. So where I'm seated as an insurer, it's the reason why I tend to support, top tier banks. It's just to make sure that the risk is good enough. But what we need to ask ourselves now, what can we do to make sure at least we can actually support, relatively smaller banks. Now, your point in terms of underlying risk, yes, for me, it's very important to make sure that underlying risk is actually within the issuer's bank. If it's somewhere else, then there must be very good justification for that. And obvious, you could have, a group bank which has a number of subsidiaries. They're trying to support, the subsidiary which is relatively weaker, but then that subsidiary also has to be within Africa, for that matter, or has to be within, an area where it's actually acceptable to us.
George, I think maybe I can just give some context in terms of the issuing banks having the availability of USD at the window as well to settle the transaction at maturity. In the case of traditional LCs, we did see over the last few months some sort of delays due to the FX not being available at maturity. So in terms of structured LCs, we understand that the issuing banks do not necessarily access the window as there's no conversion for local currency to USD. There's also no CCI required to make payment at maturity, because the CCI is only issued if the USD is converted to local currency at inception. So as a confirming bank, we rely solely on the credit risk profile of the issuing bank to make the repayment. In terms of the goods also not sort of touching Nigeria, and there not being a Form M in terms of the structure of the LC, it always does raise the question of whether the trade would be classified as a trade obligation or not. And our understanding is the fact that it is issued in an LC format, in an MT 700, also structured and governed by UCP. Our understanding is that it would be classified as a trade obligation.
So I think we're running out of time. It's a vast topic, and it can be quite technical. But we have I see that we have a series of questions which I'm hoping the panel can answer. But what we'd like to do is just sort of wrap up around the discussion, the panel discussion, and see if we've been able to influence the audience views on structured LCs. So if we can re-poll the question, please, Dan. So having heard what you have, can you please give a view as to whether structured LCs are indeed trade finance, if they're not, or if you're still unsure? That seems to be extremely successful, as far as I can tell. Oh no, there we go. There's a. So I think if we can leave it there, I think we're at 56%, 31 and 9. So very similar, except that seems that people have been informed about what structured LCs are and their little more confident that they understand what they are. We've got the last 5 minutes to answer some of the questions. Some questions have come through, and the most populous question is possibly one for you, Simon. What legal precedent, if any, can be referenced to show that a synthetic LC will be treated as a trade instrument in the event of non-payment?
I think for it to constitute as trade, it has to do what the trade documentation would normally do. And that means that commercial document has to include the usual things. It has to be done on an arm's length basis. There have to be physical goods involved somewhere. They don't have to move. They can be in the applicant's jurisdiction, the issuing bank's jurisdiction. They could be sitting in a warehouse and not go anywhere, in theory, in order to constitute trade. So I think we need to be careful about looking at this and over-egging it a bit. I think if you have the right provisions, title passing, doing all the normal things in a trade transaction, and the documentation works, the normal things happen, then it will be trade. I guess the question there was, is there any legal precedent otherwise? But your point is that there is no legal precedent to say that it won't be, provided it fulfills the trade criteria. Yes, there's no specific legal issue certainly from an English law perspective with this that's any different from a normal commercial trade transaction. It's being funded by an LC. The fact that there are other benefits does not in and of itself override what the underlying documents are doing. And then the next most populist question, to what extent do we think concern over the contagion impact of Greensill and current questions over a number of trade finance companies risks throwing further doubt over the sector and use of more imaginative products, I do like that, such as synthetic LCs? Shalina, Albert?
Yeah, sure. I think maybe it is a real risk, but if you recall, I mentioned quite early, it's quite critical to work with clients that have a demonstrated track records. And as Simon mentioned, there has to be a real flow. So working with clients that actually have these sizable flows throughout the globe, throughout the continent, I think that's quite important in terms of who you actually choose to transact with. And that also mitigates the points that we raised in terms of any insolvency in regards to the parties that are involved in the transaction.
Albert?
If you have to come in, I mean, that's our business. Our business is, I mean, we're risk takers. I mean, if something can happen 1 out of 1,000, then so be it. But I mean, Shane has just said it all. It's all about doing due diligence, the KYC. I know the mentioned, we saw it coming, and obviously we were very much aware, and we felt. I mean, it's always in public domain. I can tell you most of the time these things are in public domain, so we can actually figure out, okay, this.
Yeah, so I'm really hoping that panel discussions precisely like this are going to demystify the subject. And what's really important is structured LCs have nothing to do with supply chain financing of future receivables. And hopefully this type of discussion is going to maybe educate people who need to make decisions on these to distinguish between discrete types of trade, and that just because something happens in one form of the product, just because it's all labeled trade, it shouldn't contaminate all the rest. There's the next is what are the levels of default and protracted payment delays in the region? I guess that's more general from an LC perspective. That there's no register of structured LCs, but you can see, I think, in the ICC trade register, you can see the stats around defaults, both regionally as well as globally, and they are fantastically small for LCs. I think it does have the lowest probability of default in the trade register, below I think 0.13% or so, something of that nature. I don't know if any other members of the panel want to say anything else about the default levels.
The only thing I'd say is that what you're talking about obviously is for LCs generally, but because of the nature of structured LCs, I don't know what the number is, but I can't see that it would be anything other than lower than the LC number, because the issuing bank has the funds to pay. It's not like it's concerned about credit risk on the applicant particularly. It has the money, and so, as we said earlier, why wouldn't they pay? Now, how much of a difference that makes to the normal LC number, I don't know, but it's logically can only be less.
And I think we have technically run out of time. There are some more controversial questions on the board, but maybe we can answer those as panelists after the session. But I think that brings us to the conclusion of this very important discussion on structured LCs, and look forward to further discussions on the topic and to increased use and important use in developmental trade in Africa. Thank you.